Odile, thank you. Thank you very much for being with us. So Odile Renaud-Basso, as Martin said, she's the president of the European Bank for Reconstruction and Development. You've been there for 4 years, I think. You're just almost, and you've been reappointed, so you'll be there for 4 more years. Great. And well, and we'll get there a bit later, maybe, but I think for this crowd, Odile was also the chair of the Paris Club, so she knows a lot about that. So, but maybe let's start. So the EBRD was created after the fall of the Berlin Wall, with the objective to promote the transition of market economies to the country, to the formerly planned economy. And in the meantime, it has expanded. It has reached to many other countries. But the main mission of the EBRD is still to work with the private sector. But you also work. So here we worry about public debt, but you also work with many institutions which are at the border between the private and the public sectors, like state-owned enterprises. You cooperate with public-private partnerships, and all these type of institutions have opportunities. Maybe state-owned enterprises can be useful for providing some public goods. Public-private partnership can help in financing infrastructure projects without affecting the budget directly, but they can also lead to disasters if not well managed. They can generate contingent liabilities, can have consequences that can show up on the public debt. So my first question: how do you think about these issues within the bank to make sure that you can leverage the opportunities of this institution, which are at the border within the public and private sector, without resulting in debt explosions, which we have been discussing?
Oh, thank you very much for the invitation. And indeed, starting from the EBRD mandate, which is more focusing on the private sector, it's a bit of a paradox to come to talk about sovereign debt, but not completely, because indeed, as Ugo outlined, we've been created to finance mostly the private sector and to support transition to market economies. Our historic mandate was post-Soviet Union countries, their transformation towards market economies, but now we have progressively expanded our scope of countries in which we intervene to countries like Turkey, but also Southern Mediterranean and Middle East, Jordan, Egypt, Morocco, Tunisia, and the next phase, and we may talk about that, will be to start to invest in sub-Saharan African countries, so where the debt issues is bigger. So in the countries in which we work historically, the sovereign debt issue was not so important. And as I said, our objective is mainly the private sector. Our target is to have 75% of our financing in the private sector. But as you mentioned, we still do some project in the public sector, and preferably, and that's a very feature of us, I think, very specific feature of us, we do as much as we can without sovereign guarantee. So, for example, we do some state-owned enterprise projects, sub-sovereign, working with region, local authorities, municipalities, and so forth. And as much as we can, we work on a commercial basis without sovereign guarantees. I mean, because we believe it's the best way, to develop market and to access for them to facilitate financing. And we do, compared with other MDBs, we do both equity, some investment in equity, direct, private, and also private equity funds, and lending, which is, in terms of volume, most of what we do is lending. And as I was saying, our objective is, the core mandate is to develop market economies, and that's why we developed a big expertise, a lot of activity around state-owned enterprise. And and I will start with that, state-owned enterprise, because it can provide public goods. I think originally, historically, our intervention on state-owned enterprise was mainly to push for privatization, to start investing with an objective to create the condition for privatization. It's still there, but we can also invest, and we do also invest in state-owned enterprise that will remain owned by the state, but with the objective, I think one of the key objectives we follow in that respect is to focus on the sound management and to develop the tools to ensure that the company is properly managed so as to avoid that it wait, because you have a lot of cases of state-owned enterprise mismanaged that can have impact on the public debt. And so it's, I mean, for sustainability of public finance, but also for the quality of the output of the companies, and to avoid any kind of mismanagement which can, I mean, in when the environment is not strong enough, I mean, legally speaking and so forth, state-owned enterprise can be very easily a place where you I mean, put people from your family, you use it, I mean, as a sort of way to fund resources for, I mean, anything I mean, leaders may wish to do and so forth. So the focus on the regulatory environment, giving the companies the capacity to have to appoint, for example, a board, an independent board, clarifying the responsibilities between the government and the ministers, the line ministers, and the company in terms of who decides what are the responsibilities of the company, having an audit committee, having an independent evaluation. So ensuring, for example, that the board members cannot be dismissed for any reason, that there is a legal framework for board members to be dismissed by the government. All these are key elements to ensure that public sector companies are well managed, and that to optimize in a way the financial condition and financial output of the companies as well as their production. And this is something we've been doing both for enterprise but also banks. And banks, as you know, can be, if mismanaged, can be a very, I mean, have a very big impact in times of financial crisis, huge impact on public finance, and create huge liabilities. And one good example, for example, I have in mind is a few weeks ago I was in Uzbekistan and in discussion with the government to allow us to work on our investment in a public sector bank with a view later on to facilitate private investors to come in. And one of the key conditions and key discussion was to stop direct lending, which is the situation where the government or minister call the bank and say, you need to lend to this company. And this is a minimum quite of condition. You need to have a sound bank and so forth. So this is typically the kind of activity and focus we do. And very often we provide financing to the company or to the bank, to bringing together with this financing this kind of policy reform, governance reform attached to our loan. Another very significant example is the work we do on Ukraine, and we were very happy that the government just passed, and the parliament just voted a few months ago a new state-owned enterprise governance law, which exactly address the issues I was mentioning, which is defining what is the scope of the authority, the management of the company in terms of operational decision, how can the board members are appointed, how can they be dismissed, defining, establishing compliance function, risk management, internal audit, and so forth. All this is the outcome of 8 years of work with the authorities, with the different stakeholders, in order to bring that framework, which hopefully will have, I think, a very positive impact on the financial situation of the company and the way they deliver and the goods. And we have been doing that in a number of countries. It can be in all sectors, banking, but also electricity network, for example, or energy production in Albania, or and it's very often. Very often we work hand in hand with IMF, because they will come, and when you have a country has an IMF program, they could identify, they could see as, I mean, reform of the state-owned sectors as a component to have a positive impact on public finance and so forth, and that gives us a basis also to go more at a micro level, to work company by company to improve the situation. And if I come back to the example of Ukraine, for example, Ukraine had a huge financial crisis in the middle of the around 2015, 2014. Huge effort to clean up the banking sector, recapitalize the banking sector, improve the governance, have independent board members in the banks and so forth. And this has proven a huge asset now in the context of the war, to have a functioning banking sector, resilient, with a capital absorption capacity to face the very dire situation and so forth. So we see the long-term benefits of this kind of intervention. You mentioned also PPP, and it's a different perspective. It's, for us, PPP has a lot of benefits, but of course it has benefits and condition for success. It has also had some drawbacks, and you have some big failures in terms of PPPs. What, in our perspective, what PPP can bring, so public-private partnership can bring, is you bring in to develop an infrastructure, an investment. You bring the expertise of the private sector, the know-how, the responsibility of the private sector, and with possible quite high efficiency, and we see that it's, I mean, so all this expertise and know-how, as I was saying, can be brought. It has some conditions for success, and I think that the first one is to have a sound legal framework, to have clarity about what is the responsibility of the state, what are the rights of the private partners, and so have a clear and transparent regulatory framework, which often does not exist. So we see that as a precondition to be able to develop efficient PPPs. The second thing, and it's very important, is the preparation. It's very complex. I mean, very often it's complex, and you need to have a good preparation. And that's why we invest and we put quite a lot of resources in helping the countries which are interested in developing PPPs to have this preparatory function with dedicated teams trained that can negotiate the different parameters and so forth. And I think this is it's quite important investment, but a big condition for success. And we ourselves finance this kind of preparation, and we have ourselves some dedicated teams to prepare that. The third condition is transparency, and the fact that has been one of the weaknesses, I think, in the past, that it needs to be fully transparent in terms of what are the risks and the government keeps, what are the risks the private sector takes, and transparency in the accounting, because very often it's seen as a way not to have the full costs from the start, but then you have repeated costs, and this needs to be, I mean, it's either direct liabilities if you have availability payments, or it's contingent liability if you have more risk taken by the private sector and just a contingent guarantee from the government or the public sector. But this needs to be accounted somewhere and reflected somewhere. And in my view, I think it's, I mean, of course, in each case, you have a sort of risk-sharing approach, but in my view, it makes a lot of, I mean, more sense probably, and when you have revenues associated to the PPPs that and the sort of paying back for the PPPs type of concession model, airport model, and so forth. But so we have on this basis, based on these different components, some very successful element. Not so much as a way, I think, and we don't see that as a much to avoid public finance constraints, but more bringing, I mean, diversifying the scope of investors that can invest in the country, and bringing expertise that the country does not necessarily have. For example, one of example of successful PPPs in the airport, because if a country less advanced has one airport, I mean, the know-how of how you best develop an airport and so forth is, I mean, you can rely on international expertise, which could be very effective, and that's a kind of example of successful PPPs, but also water management, road, and so forth. And so for us, we promote, we encourage countries to do that. It's always a choice by the country, but we really are quite focused on the conditions for that to be a success.
Thank you very much. So by the way, I think we're organized this 1 hour like this. I'm gonna ask Odile 2 or 3 questions, and then we'll open for questions from the floor. So so you mentioned your work with Ukraine, which I think it's must have been a big shock for you, one of your big client countries being in the middle of a war, and I know there is a lot of engagement with Ukraine. But there is thinking about the sovereign debt, the sovereign risk part. There has been some spillover to neighboring countries, which have seen their borrowing costs going up. I mean, borrowing costs have gone up almost in many places after the Russian invasion in Ukraine, but then many countries went down, but in some of the neighboring countries are still, they remained high. And I don't know, can you tell us a little bit how this affects your operation, whether you can help these countries which are facing particularly tight financial conditions? What are you doing in the region?
Yes, it's quite striking to see the impact the Ukraine war has on the region, and it's in well advanced countries from belonging to the EU, for example, the Baltic states or Poland. It's not that it doesn't trigger a sort of sustainability crisis situation, and really, but the impact of the cost of funding and the type of capital they can attract is quite important, and it's lasting, and because there is this halo of, in particular, from foreign investors outside the EU, US investors and so forth, for example, who are quite far away but see that, okay, I'm very close to the war and with a possible risk of contagion, and the Baltic countries, for example, are particularly vocal about the perception that they are the next in line if there is a further, if the war in Ukraine is not, is a win for success for Russia, and then they could go be further. So this is for a few months the market was really shut. It's completely shut down, the market. So no issuance possible, including by very well established private banks and so forth. And now the spread, the spread remains. So for all the countries, we had a big increase of all our countries, a big increase of the interest rates overall, but the spread with the German or US, they decreased, but for all these neighboring countries, Baltic, Poland, and so forth, the spread remained above, the difference of 1% compared with before the war, which is quite significant. And as a consequence, EBRD, we went slowing down or very focused on the kind of investment we were doing in these countries. We have increased our engagement. For example, Poland last year, we invested more than 1.2 billion among the largest countries in which we invest, because of we saw our additionality coming back, where lack of appetite from other investors, and our value added is more important, including for market issuance, for example, for key private sector players, where we play the role of an anchor investor, buying a minimum share of the issuance and then giving some confidence to investors. One area where it's very striking is everything related to private equity investors, where really now it's very difficult for them to raise money for the region. Just one word maybe because we are talking about Ukraine, the question of the sustainability of Ukrainian debt will be, is very central to the discussion and central to the IMF program and so forth. And we've been looking at EBRD, our economists have been looking at 200 years of impact of war, looking at war and the impact of war on the debt. And statistically, they showed that a war after, basically between entering the war and at the end of the war, the increase in the debt is 50%. And we already see that in Ukraine between 2022 and 2024. That is what expected, so plus 50% of debt level. And that's why, I mean, in the context of the IMF program, now there are some ongoing discussions with the private sector on debt restructuring and a commitment from the official sector to discuss and to take some measures to ensure debt sustainability. Not MDBs, we are not, because we are, I mean, our preferred creditor status is for us very important, but overall a commitment from the bilateral.
Thank you. So you mentioned before, so as you said, the EBRD started as a 12-country transition out of the planned economy. Then you expanded to Turkey, which I think is one of your largest clients, or used to be one of your largest clients. Then you moved to North Africa, Middle East, and now you're expanding to Africa. I think 6 countries in Africa. I think Nigeria is the last one, so it's a very big country. So these are countries that they do have debt problems. Well, also some of the countries in the Middle East have debt problems. And so what is your thinking in dealing with this country? How you're going to incorporate possible debt issues in the new countries with whom you'll be working with?
So, I mean, our focus will be mainly on the private sector. So we do not expect to work too much at the sovereign level, and to work with, I mean, mostly on the private sector, and at SME, but also, I mean, attracting FDI and working at the sovereign level, possibly in the public sector with sub-sovereign or with state-owned enterprise without public sector guarantee, without government guarantees. So that's our thinking. We have not started yet, so that's something that we will need to assess country by country what are the options, and one important way to work with and to touch for us to have an impact on SMEs, and in particular, I think in sub-Saharan Africa it will be important because the size of the companies is relatively small and so forth, is to work through the banking sector, providing them some targeted credit line to finance, for example, a green project or a project for supported by young people or women. So we try to bring some blended instruments where we provide together some financing, but also technical assistance. I mean, grants that finance technical assistance and so forth. And I guess that for the things we will be doing in the public sector, we will work also on blending finance, mixing. I mean, in order to avoid the issue of debt sustainability, I mean, and to be as concessional as possible in terms of when working at the government level. So but that's true that for us it will be quite a new environment, because currently the only country which has this sort of constraint is Tajikistan. So we used to work in an environment where the sovereign debt levels are not such a big issue, but that will become quite a new feature, and that's why I think what we can bring in the private sector will be so important.
Very good. So now I'm going to ask you to remove your current hat and put your old hat as a chair of the Paris Club. And so how, I'm sure you now you see, I guess, the situation from a different vantage point, and I'm sure you still talk with your friends in the Secretariat here in Paris. And so what's your view? How do you see the situation? And so there are still a lot of issues with the international debt architecture. We've been talking about this for the past 2 days. So there is the issue of the common framework, the issue of the sovereign debt roundtable, and I guess the general feeling that there were a lot of expectations that this would solve a lot of problems, but it's not moving as fast or as well as expected. So I wanted to see what your perception on these issues here, and whether you're optimistic or not.
So I'm not anymore in the detail of the discussion and so forth, but indeed I think that you are right saying that it's been much slower than what was expected and complex and so forth. I think that it's on the other hand, I also see some positive signs, and I think that when you look at how debt treatment has evolved also in the past, it has always been a bit of try and test and progress and build a common understanding and so forth. So I was reading the outcome of the sovereign debt roundtable of the last annual meeting, I think in April, and I was thinking that I mean there are some progress which are being made, and the complexity and it's not completely a surprise that it takes time to build a common understanding and so forth. Also, when you think about the geopolitical tension, the situation with China and so forth, and I think that we tend, because I was still chairing the Paris Club of the Paris Club, when we really engage quite a lot with China to start cooperating with them, invite them to participate. They were at that point of time participating as observers to our meetings, and so to understand how the things work, how the principles of Paris Club treatment, how the transparency principle, how you share data, but then what is the interest you have to join forces in order and ensure comparability of treatment and so forth. So all this process, and at that point of time, I remember suddenly we realized that one of the challenge for China was, of course, whether they had appetite to participate to this effort, so it was too much Western driven or not, and so forth. But one of the very practical limitations for them was internal organization in order to know what kind of debt should be treated, to understand what the others were doing, and find a process internally between Exim Bank and other entities of who should be in the driver's seat, whether it was the ministry, the central bank, how to coordinate. You have this, very different structure, which have all engage. All extended some financing, and all want to protect their own claims. So all this framework, for example, this takes time to develop. In France, we had we had the COFAS, and we had the debt of Banque de France. So all this structuration of tools in order to be able to restructure the debt and so forth, and to understand how it works, that's normal that it takes time. But I hope that progress can accelerate, because indeed it's a real problem to see such a long time between, and it blocks implementation of IMF agreement and so forth. It's a tragedy for the countries which cannot benefit from quick debt treatment, so I hope that we see a bit of acceleration in the different cases. In the 4 cases that have been gone through, I think there is a bit of acceleration, and I hope that working together and really trying to address the very specific question, for example, of how to being more transparent on comparability of treatment, what is really expected, what is the role of the different the creditors committees, IMF, private sector, and so forth. I think that's very important. But I'm quite optimistic that there will be some further progress, and that I think it's very important to keep the pressure on the system so that further progress are made. But of course, the private sector is a bit more complex, because it's always but there also, I think that better communication and so forth will be instrumental to get to a better outcome for the countries.
Optimistic. Elena, before, was telling us from Moody's that they're thinking that defaults are going to increase over time. So we do need to keep the pressure. So the idea was, I started with a few questions, but I think we can use the remaining half of the conversation, the question from the floor. So if anybody has questions for Odile. Martin?
Yes.
Yeah, there are microphone next.
Yes. So thank you very much. I was wondering, you mentioned your preferred creditor status. I was just wondering how it worked, as an investor in mainly the private sector. How do we think about the preferred creditor status?
So indeed, it's very different from when you work with the private sector, and there it means that we have access to currency so the country cannot block our repayment in foreign currency. So it's sort of, it's not like if we have a private client, if it defaults. I mean, there is no, that's our loss. But in terms of access to currency to pay us back and so forth, we have this. I mean, that's where our preferred creditor status plays, so that we are paid if the local client pays us. I mean, then the government, it has to go through the payment system and so forth. So for us to be repaid, so it's not such a big protection. I mean, it's much more limited and targeted than for the sovereign debt, but it's still something which has some value in the countries in which we intervene. But otherwise, when we work in the public sector with the public sector guarantee, we benefit from the preferred creditor status, and it was a big discussion when we work in Ukraine, because in the first 2 years we worked with the guarantees from government, and we were very careful so the guarantees were covering basically half of our risk. And we were very careful in the design of the guarantees not to extend the preferred creditor status, because then it would have completely distorted the capacity of treat the debt whenever it comes. So that is something we were so we have it for MDBs, but not for the bilateral donors.
Yeah. There is a microphone in the chair.
Is this activated? Yep. Okay. So I'm Randall Henning at American University. I would be very interested in getting your perspective on and hear about your participation in the discussion among the multilateral development banks about the capital adequacy framework, right? Ramping up the balance sheet and in even sharing capital. So I know that the Asian Infrastructure Investment Bank, for example, has made some capital loans to the World Bank. And I was curious about where you think that agenda should go and how much benefit we can get from it in terms of delivering resources to low-income countries.
So this agenda has delivered already quite a lot. I think the last assessment I've seen is 200 billion additional financial capacity generated by the capital adequacy framework implementation. The first thing it has, so the exercise has been very useful in comparing the situation of the different banks and identifying areas where some progress could be made in terms of, for example, taking into account the impact of the preferred creditor status, taking into account how to better take into account the callable capital. You know that the MDBs, they have paid-in capital and so forth, but they have also a large share and a very large share of callable capital, but the conditions to mobilize, to use the callable capital are not very precise or a bit, but still some of us, and EBRD was quite advanced into that, were already taking a part of the callable capital in its risk appetite, and so leveraging on that. So I think, and for example, Asian Development Bank was not doing that at all, so they look at what others were doing, apply the same thing, and for them it unlocked I think 10 billion additional capacity per year for 10 years, so $100 billion. So only for this, it has been very useful. It has also triggered a lot of dialogue between governments, MDBs, and rating agencies about, what are the limits, the model, and so forth. So the discussion is ongoing. It may bring some results. For example, on the callable capital, credit rating agency maybe more. We produced, a number of MDBs have produced a report defining exactly how it would apply for them, and that may bring CRAs to reconsider how it's dealt with and give a bit more uplift because of the callable capital. It has also opened some, there were a lot of discussion on new instruments, for example, a hybrid capital, and African Development Bank has launched first hybrid capital insurance, and it's quite interesting to see how it's, it's quite costly but it's useful. And as you were mentioning, also guarantees from MDBs to other, there were in the past some exchange of exposure in order to unlock and to address concentration risk in some MDBs. So that already happened before, but now there is this capacity to guarantee or to get some guarantees from shareholders to unlock some additional capacity. So I think overall it has been useful to better understand the different methodological issues, approach, and so forth. It's not unlimited. And for example, in our case, at the end of the day, shareholders agreed that it was needed for us to have a real traditional capital increase because of the risk we are taking in Ukraine and so forth. So it's not, there is no, capital adequacy framework, it will not unlock unlimited capacities and so forth, but it has helped to make some progress and unlock some capacities, which quite substantial because 200 billion is already quite a lot. So, and it also has triggered, and that's much more cooperation between MDBs, CFO at all levels. I think that it's quite a new trend to see. This concept of MDB working as a system and much more at work, I think, on financial issues, but also on climate issues, on policy issues, and so forth. So I think that's a new dynamic also, which is quite interesting. Yeah.
One question here.
Frederic Dahan from ODI. Given your extension to Sub-Saharan Africa and also the renewed commitment towards Ukraine and the fiscal constraint of these countries, especially Ukraine, do you think that the ratio private-public that EBRD has applied throughout its life, about 75%, is likely to be challenged with an increase towards public sector?
It's a very good question because it's a very topical question because indeed in Ukraine it's quite distorted because Ukraine is a big country for us. We do a lot, and last year we did half in the public sector, half in the private sector. And the main challenge for us is not so much the new financing we provide each year because we were quite. We reached this 70%, 75% quite easily. The challenge is more when you look at the portfolio, and we have some in our rules, some rules related to portfolio, and then the trick is that the private sector financing is much more short-term, 5 years maximum, 7 years maybe. Some infrastructure project in the public sector, maybe 20, 30 years. So that in the portfolios there is a bit of distortion and towards more public sector, and that's something we need to keep in mind and some shareholders are quite keen for us to remain very, very vigilant around that. So that's something in Sub-Saharan Africa, I think that I was saying because of the debt issue, sustainability of debt issues, we will focus mainly on the private sector. But we will see also on the ground what we really try to do is create an environment conducive to have private sector, including in infrastructure, energy, and so forth, and help addressing the challenges of development.
There is a question up there, but if you could just bear with me 1 second, I have a curiosity. What is your timeline for starting operating in Sub-Saharan Africa?
So we expect 2025. So to start in 2025 and to step up progressively because we are, our shareholders have to change our article of agreement, so our statute. So it's in the making. It takes a bit of time. So 25 next year.
Question up there.
My name is Marina Zucker-Marx from Boston University. I would like to ask you a question. Beyond MDB participation, collaboration among the MDBs, some multilateral development banks also collaborate with national development banks and commercial banks. What is the position of your bank related to this? Do you also do on lending as other MDBs, or is it different because you operate more with the private sector? Thank you.
So we do a lot of co-financing with other MDBs, and we try to, one of our topical issue now is to do more mutual alliance. So when we have the same project, we work on the same project, apply, one MDB is in the lead, and we try to, we follow this MDB. We work also with bilateral development institutions, so which are doing development, so DFI from different countries. We do that, for example, in Ukraine, where we created a platform because for a number of DFI, they were not very, they didn't know the country very well, they didn't have presence in the ground. So we sort of shared project in order to facilitate their investment in Ukraine. But we also have, do bilateral project with a different bilateral institution. With national development bank, so public sector bank in the countries, it's really case by case. We are very sensitive to not to work with banks which are politically driven, and so there are some countries, so which would be, as I was mentioning, the case of Uzbekistan, have a sort of apply political instruction to, but in a number of countries, when the governance and the setup is, we trust the system, the governance and the independence of the bank and so forth. We can work with National Development Bank. We are member of Finance in Common initiative, and so have this kind of cooperation also at a global level. But there are some countries in which we would not work at all with National Development Bank, because the management would be tied to the government, very politically exposed and so forth. So for us, it would be a sort of red line that we would not like to, we could not work with them. But we look at the situation country by country.
Isaac.
Yes, Isaac Diwan from the FDL. You spoke a little bit about guarantees and blended finance. Perhaps you can tell us more, because there is so much noise about blended finance becoming very large, in particular on climate, reaching hundreds of billions of dollars, yet it appears to be small. So how do you see the potential there? And on these guarantees, what kind of leverage are you able to achieve? Your bank has a lot of experience with that.
So it's very difficult to give a figure on the leverage, because it depends completely of the type of risk, the circumstances, and so forth. For example, for Ukraine in the war, we were asking guarantee 50%. So for €1 of guarantee, we could lend 2. So very relatively small leverage, but if we develop product with first loss guarantee, and then it can be 1 to 10, it can be 1 to, it really depending on the sector, the level of the risk, and the specific environment. I think we develop quite a lot this kind of instrument. For example, the EU, European Union, which is one big donor support for us, they have developed much more guarantee mechanism than grants that we would distribute. We have an approach which is quite selective, in the sense that we try to use blended finance when it's needed, in order to avoid crowding out of the market. Because I think that one of the core objectives of the bank is, as I was saying, to develop markets. So we do not want to finance when we are not needed, and we do not want to bring blended finance when it's not needed. But there are areas where blended finance is needed, either because the risk is too high, or because you need some concessionality for the clients, and so forth. So we are really trying to focus on that. When you link that with the climate, I think that there are a bit of a mismatch between the expectation. There is a bit of narrative from international private sector saying we have hundreds of billions of investment, capacity to invest, but we just guarantee us and we will do whatever you need. This is not going to happen, because the cost of the guarantee, is very, and the public resource you would need to guarantee that is very high. So that's why I really believe that because we really need to have this private sector investment in the transition, in emerging countries and so forth. All the work to be done on the environment, create the environment that make it possible for a private investor to invest is extremely important, and it cannot be substituted by guarantee, first loss guarantee, and so forth. So that's the nuanced response I would have, but it's absolutely needed. We do it more and more. I think that, and the leverage, I think, is positive, but it cannot solve everything.
Yes.
I can't hear you very well. I don't know where the mic.
No. Let's do this.
Thank you very much. Penelope Hawkins from UNCTAD. Just following up on the question around capitalization and Randall's question about the capital adequacy framework. I really would appreciate your opinion on SDR rechanneling through MDBs. We know that there's some things on the table with the African Development Bank and IADB. How do you see that?
So I would be very happy to have SDR, I mean, and that it works, that if the scheme that has been worked upon can work. I say that in the Banque de France, which I think in Europe, the bank are quite ECB is quite reluctant. I was clearly not willing to participate to this kind of scheme. I think that there has been quite a lot of work done in order to preserve the nature of, reserve of SDR with some lending and then liquidity pool in order to guarantee that at every time it can be, SDR are available. So I think it would be great if it can work for NDBs. We are still not there yet, I think, because the pool of the central bank willing to participate to this kind of scheme are not, there is not enough for the time being, so it's still in the making, but if it can be done. It's true that conceptually it's quite complex, because it's reserve assets, but I believe that the framework that has been put in place, and I understand has been endorsed by IMF as a sort of, it preserves the nature of the SDR, is a good solution to, increase MDB's capacity without having too much. But I hope it will work. It's been discussed for more than 2 years now. So I don't know whether it will. I think African Development Bank is quite optimistic that they will manage, but let's see whether they really have the sufficient pool and sufficient level of commitment from different central banks.
Yes.
Okay. Just out of curiosity, with regards to sub-Saharan Africa in general, and more particularly to Nigeria, what development partners do you see yourself working with? Say, for instance, DBN, Development Bank of Nigeria, or AFDB, or Afrexim Bank. So that's the first question. Second question, are there going to be M&E systems in place to ensure that these institutions actually on-lend to, say, SMEs? Second, and then the third question is, I know you talked about lending to climate-related firms, or firms that seek to target climate issues, but are you also considering non-traditional sectors, say the creative sector, for instance?
So we have no, we have no limitation in terms of sector as soon as it's a business that makes some money and that can pay us back and so forth. So we can, it's not creative sector, it's not, our historic sort of key sectors are more so infrastructure, industrial, agriculture, tourism, and so forth. But it depends on we are demand driven, so we see the project. If the project has, we can finance some related. creative-related business. In terms of partner, it's a bit early to say because we will look, but we in all the countries in which we intervene, whenever we can, and with the limitation I was saying, when you have a banking sector which is only owned by oligarchs or the family of the president, we will not work with them. But otherwise, we work a lot with the local banks. So we assess them one by one. We develop partnership, and then we own land through them with a commitment for how they would use. The proceed the money we lend them, and we check that, and we also are developing a new category because in some countries the banking sector is very liquid, so they do not need credit line, they are not interested, but they are very cautious in terms of risk taking. And what we can do is taking some sort of unfunded guarantee portfolio. That's what we are doing in Ukraine. We've developed a big portfolio guarantee where we cover 50% of the risk they take to SMEs. This needs need to have trust and to know well the institution and have a good understanding of how they choose the risk, how they choose the counterpart, and so forth. But it's something we are willing to develop because we believe it's quite relevant tool in a number of countries. And we also work a lot, for example, in trying to bring together the support we provide to banks and climate, and working with our client bank on Paris alignment, so as to help developing with them their governance framework, the methodology, so as to ensure that all their lending will be Paris aligned, so with project consistent to Paris agreement. So that's where we try to bring also added value in terms of supporting the banks or the clients to go a step beyond in terms of green impact and activity.
I think we can still take one question. So, Martin.
I also go back to your previous job as a president of the Paris Club. You were there until in 2020, so you saw the birth of the DSSI. I was wondering if you had a view on its success, its failure, what you thought, in retrospect of what it achieved, the debt service suspension initiative.
No, I think the failure is the timing. I think it's the SSI as such has been successful in sort of providing short-term relief and so forth, but then when to go the step beyond on the debt common framework and so forth, the timing and the length of time needed to reach an agreement and to address the issues is it's too long. But I think that the principle of the framework and so forth are the right one. So, I don't think that, and that's because of probably, I've been working a lot with the Paris Club, and I see the benefits of sort of this kind of flexible, where it's not a formal institution, it's not but you find ways to cooperate but then it takes time to build, but when it's up and running, I think it's quite efficient because it helps to address different situations, different scope of creditors, different, so the challenge is the fact that we are still in the building up of the consensus and so forth, and that you have some the geopolitical tension, disruption, and so forth do not help in making the progress at a sufficient pace. I think that's a bit of but it's not so much because of conceptual flow of the system, but more the environment, which is not so conducive, I would say. But
maybe I'll make I don't know if it's a comment or a question, but it's a comment on something that you said when you were talking about the blended finance. And you say we have to be careful about it to do it right. And I think that's you're 100% right. So one day I was looking at an operation done in the country where I live, in Switzerland, and I looked at this operation, this blended out finance operation. So the Swiss government agency did the risking, did everything, and then a private sector financial institution came in and asked, I don't remember, but LIBOR plus something, basically the same amount that they would have asked if all these guarantees were not in place. And this ended up being a massive transfer of resources from the public sector to the private sector, but not the private sector you want to benefit the ultimate borrower, but to the bank that provided the lending. So I think you're 100% right that you need to be very careful in evaluating what type of subsidy and who gets the subsidy, because you want it to go to the final beneficiary and not to the...
Yes, you always have the risk return, and you need to be sure that if you de-risk, you also de-return in a way, or reduce the return, because the risk is that you have no risk but high return. Yeah.
So I think our hour is over. So let me just thank again Odile for taking the time and coming here, and thanks again to Martin and the team of FDL and Banque de France for the amazing auditorium. And so, thank you.
Thank you.
Just to conclude, I thank you both very much for this great conversation. I have the same message as yesterday. I know we had a lot of excellent papers. We had to be selective, but still we had a lot of sessions to put, and so we're starting again tomorrow at 8 a.m. And I would love if most of you could be there. There's 3 sessions, so be there, and all really fascinating. So to come.